Hello, business builders, and welcome to Business for Breakfast, where business is the most important meal of the day. I'm your host, Aaron Novinger, the Venti business guy. Our goal on this channel is to give you a ton of micro lessons to help you mind your own business. Hang out with me today as we drive and dive, where we dive into topics that every business owner, especially us mom and pop Venti shops, need to hear. Today, it's our Biz Tax Crash Course 301. This is part 3. Buckle up and let's roll. All right. Oh my word, am I excited about today. Now, I do have to do a little caveat. So yesterday, when I finished up, or not yesterday, but when we finished up our video, we finished with section number 9. And so I'm gonna go ahead and finish out with 10 today. And we're just gonna do 10 through basically 15, okay? Or it's actually 14. So it's gonna be really 10 through 14, okay? So section number 10 is really gonna be based off of chart of accounts. And again, how we structure the business finances, okay? So again, this course is designed to basically give you an accounting course over a semester over just a few podcasts that you get a chance to listen to, okay? But as a small business owner, we've talked about this before, keeping track of your financial transactions is quite literally essential, right? For you understanding your profitability, how you manage your cash flow, and also just as important is how you prepare for your taxes, okay? So the chart of accounts, remember the COA, we talked about before, that's the foundation of your reconciliation system, your bookkeeping system, okay? It really is designed to organize all of your business accounts in an optimal way, an efficient way that really helps you, I don't know, easily categorize your expenses and your income and really your assets and your liabilities, like the main four, right? So let's dive into the chart of accounts, what it is, why it's important, okay? And we understand what the chart of account is, okay? It's your filing system for your business, right? It's the structured list of all those expenses, okay? Remember, it's divided into the categories, the 5 categories, assets, okay? And that's what you own, right? Then we've got our liabilities, and that's what we owe, okay? Then we have our equity, and that's honestly what's left over, okay? And that's really the owner's stake in the business. And it's really their contributions plus like their retained earnings, right? Then you've got your revenue, and that's your income, okay? And that's the money that the business earns from like the sales of your product or service, plus the other income, your service income or other income. Then we have expenses, and that's going to be really what it costs to run the business, okay? Rent, payroll, software, marketing, stuff like that, okay? And again, why it matters. Because a properly executed chart of accounts makes running your business so stinking easy, because you know exactly where your money's going and coming. You know it. It just really helps you stay profitable and on track, okay? And an example of how we categorized our expenses, okay? So we talked about that before. Every single financial transaction, especially when we're talking about double entry accounting, okay, affects 2 accounts, okay? The credits and the debits, okay? So remember the example we gave. If we purchase a laptop on credit for $1,000, right? You buy the laptop, okay, for your business, you put it on your credit card, right? You have to categorize that in your chart of accounts. We discussed that. Remember what the books looks like, okay? So the account name, what does it show? Office equipment, it's an asset, okay? And then we mark it as a debit of $1,000, okay? And then the next transaction, because remember they got to be zeroed out, okay? Then rolls into next transaction, okay, credit card payable, liability, debt, where it says debit, that's 0, credit, okay, $1,000. Okay, so we have to make sure that they even out. The laptop is an asset, so we debit, okay, which means increase the office equipment account. Since it was purchased on credit, we increase the credit card payable liability. Okay? This categorization is what helps us ensure our financial records reflect both what you own, which is the laptop, and what you owe, which is the credit card balance. You get it? You can see it, right? This is why the chart of accounts is so stinking important for you as a small business owner, okay? It keeps your financials organized, simplifies your tax preparation, okay? Once again, helps you with your decision making. It helps you with decision making, and then it also really helps you overall, lets you know where your money's coming and going, and helps you really prepare for growth, okay? As the business grows and scales, your chart of accounts becomes more and more important, okay? Because we also get into things like if you have different offices, right? Different locations, okay? How do we categorize those? And so that's the thing. One of the biggest mistakes our small business owners make, again, is mixing the personal and business transactions, which, trust me in this, leads to nightmares, and you can never balance your account, and you can never set a budget, and you can never figure out how much you need to take as a paycheck, because you're mixing these, and they're not supposed to be mixed, okay? Its only job for your chart of accounts is to ensure that all your business activity is recorded separately and, most importantly, accurately, okay? So let's move into some very easy takeaways from this, okay? Number one for you, the owner, structure your chart of accounts in a very simplistic way to help you track your transactions. Google your industry, figure out a template chart of accounts, and use those as your high-level categories, okay? Helps you categorize your your financial activity into a few different places. Remember the 5. Into assets, liabilities, your equity, your revenue, and your expenses, okay? Let's see, another big takeaway. As long as you keep your chart of accounts up to date and accurate, it honestly does save you money, because it simplifies your bookkeeping, your accounting, your tax filing, all your reporting. And I don't yet know of an accounting firm that works for free, unless it's your mom or your wife or your kid. But usually accountants charge by the hour. So if we can simplify this stuff and make it more efficient for your accountant, we do want to learn how to save money, right? Okay, so I think we have a clear understanding. By structuring it properly, it fixes all that, right? Okay, let's move into our next section. And again, we're going to be talking about some things we talked about before, but a little bit more in depth and detail. Okay, so next section for us is going to be back on journal entries and our T accounts. Okay, but again, last time we discussed what they are. Now we're talking about how do we record these. This is about not what they are, but how we record them when we're documenting all this. Okay. Now remember, our small business owners, our entrepreneurs. We've got to keep accurate and up-to-date financial records, because again, it helps us track our cash flow, helps us make sure that we're prepared for taxes, and again, helps us make informed decisions on our business, okay? But how do we record the journal entries and those T account transactions we discussed, okay? And understanding the journal entries, and we talked about before, even if you do a very simplified spreadsheet, each of those line items in the spreadsheet or the document or the software is a building block. And this is what builds the foundation for your accounting, your personal business's accounting, okay? And remember, we talked about that before. Think of your journal entry like logging a transaction in a checkbook, okay? Very easy. And actually, journal entry can literally be as simple as the categories on a checkbook, okay? But just like a checkbook, its job is to record the details of all the transactions, okay? Making sure that we have an accurate snapshot of where we're at financially, okay? And remember, all of our journal entries consist of the same thing. okay? A date, remember we talked about it before, like even as simplified as we can make it. A date, okay? The account that was affected, okay? And when I say date, not the date that you're recording this, but the date the transaction occurred, right? The date you bought gas, the day you went to Walmart, whatever it is, okay? Then the account affected, okay? Or it's not the account affected, because remember, every transaction affects two accounts, okay? So it's really the accounts affected, okay? Because remember, the accounts that increase or actually decrease, right? Because you got all these accounts that increase or decrease, okay? So very simply, we've got assets and liabilities, and then don't forget, we've also got equity, the revenue, and the expenses that all get affected by this transaction, okay? Don't forget, we also have our business description, right? So this is the actual description of the transaction, right? And then the amount. So usually it's like date, the accounts affected, okay? And then remember, they gotta neutralize the amount you spent, which you typically want to, if you can, coordinate with, make sure it coordinates with the bank account, and then a description. Not a big description. It could be a brief description, but you just need to know, okay? So, like for an example, for advertising, you spent $250 on Facebook ads, okay? Here's what it looks like for your journal entry. Remember, it's like the account name, or the date, the account name, then the debit, right? Then the credit, and then usually the amount, and then description, okay? So we know the date, and again, we're doing all this as if it's January 1st, it's a new day, okay? So date, easy. First journal entry, because remember, every transaction has two journal entries, right? The debit and the credit, okay? So we've got the date, January 1st for both of them, okay? The account name on the first journal entry, it'll be an advertising expense with a $250 debit, okay? Then the next journal entry, same date, January 1st, okay, account name. But remember, we gotta neutralize it with double entry and put in cash. So then we say cash for the account name, we put cash. And then we do a credit. Okay, so remember, the debit's on the left side, the credit's on the right side. Now it's neutralized, okay? Remember, your advertising expense is debited, okay, because it's a business cost, okay? The cash is credited because it's money leaving the business, okay? So the basic rule of thumb, debits must always equal credits, okay? Let me say that again. Debits must always equal credits. Again, debits must always equal credits. Again, debits must always equal credits. Again, debits must always equal credits. Okay. Now, T accounts, okay? And again, we're talking about, this is a visual guide, okay, that really helps you understand better the debits and credits, because they can literally just be on one side of the T. And we're talking about a T, drawing a capital T on a piece of paper. We've got one horizontal line with a vertical line that separates the horizontal line, okay? And we're talking about the same $250 spent for advertising for Facebook ads, okay? We're talking about the left side and the right side, okay? Left side of the T, the right side of the T, okay? So going back to what we talked about before, right? So left side is gonna be the expense, that's the debit, right? And then on the right-hand side would be the cash, the credit. So they neutralize. So the expenses increase with debits on the left side. Cash decreases with credits on the right side, okay? But here's why it matters. Instead of looking at this massive list of transactions where every one of them has two, your T accounts, you can quite literally see, and actually like quickly, how the money's moving to the different accounts, because it's just across the line. It simplifies it. This is always about what makes it easier for us as business owners. You see what I'm saying? All right. Why are journal entries and T accounts important to you as the mom and pop Venti shop or the entrepreneur? Again, helps you track your money. Again, helps you stay organized. Again, helps you make better financial decisions. Again, okay? But here's the deal. one of the big mistakes, okay, that a lot of our business owners make is they only check their bank account balances, assuming that's the actual amount of money they have to use to spend for their business that day. Sometimes it is, but most of the time it's not, okay? But here's the kicker. If you're not tracking your revenue, your expenses, your liabilities, everything, and not tracking it properly, this calculation is gonna be wrong, period, okay? And you guys remember that old Peter Drucker saying, you can't manage what you don't measure. But it needs to be taken a little step further. You can't manage what you don't measure accurately. You got to measure it accurately, okay? Now, let's talk about some takeaways for you as a business owner. And again, we're going to keep it KISS, okay? Keep it smart and simple, right? I don't like calling people stupid, right? 1, high level, every transaction has a debit and a credit, okay? Every transaction is a debit and a credit. Okay, another point. Journal entries record financial activity. The same way your checkbook ledger records financial activity. Okay, they're the same thing. One's for the personal, one's for the business. T accounts help you visually track the changes in your accounts because it's sitting on one side of the line and then the other side of the line, okay? And then understanding all of these tools help you manage your business. Or like we said, all of this helps you mind your own business, right? All right, let's move into our next section, which I believe is section 12, okay? And we're talking specifically about building financial statements from your transactions, okay? Now, this is a biggie because most of the time, business owners, as soon as they get the financials and they look at them, it's like an immediate sense of being overwhelmed. And by the way, I'm not even disagreeing with that. It is very overwhelming, okay? I 100% agree with it. Coming from a fellow struggler of ADD, looking at this without an idea of what it means is very overwhelming, okay? But here's the truth. These reports are just a reflection of your day-to-day transactions, okay? So that's all this is. It's just a report. It's a snapshot, okay? Every sale that you made, every expense that you spent, all your investments that you make, all affect your profit and loss statements and your balance sheets, right? I think you guys understand that, right? In this transaction, we're going to look at that in more detail, okay? We're going to walk through real world transactions to see how they shape and affect your business, okay? So by the end of this, you should clearly understand how your financial statements are built, okay? Why they matter, and again, how they're going to help you make smarter decisions, okay? So let's turn those transactions into actual statements, shall we? Okay, so imagine you own a company, ABC Pest Control. Got it, okay. Now, let's say that, again, we're gonna start with easy stuff here. You started January 1st, you're the owner, you contributed $1,000 to start the business. All right, January 15th, so two weeks in, the business spends $250 on Facebook ads for customers. Cool. And then let's say January, 28th, okay, at the end of the month, ABC Pest Control sells a big pest control job for $5,000 and you got paid in cash, okay? And let's say that was on January 28th, and let's say on the 29th, the next day, you're like, OMG, probably need to be able to do some invoicing here. I don't have a computer, so the next day, which is the 29th, you go out and buy a $1,000 laptop and you put it on the credit card. Cool? Okay, now, let's talk about how these transactions need to be recorded, okay? So we already know, first we'll talk about the profit and loss statement, okay? And remember, that's tracking your income and expenses. So top line is the revenue, then your expenses, and then your revenue, okay? Your profit. All right, talking about the P&L statement, let's see, ABC Pest Control, okay? Your profit and loss statement for January, okay? It's gonna show, remember, top line, $5,000 for revenue, okay? Expenses was what? You had two expenses. One was advertising of $250 for your Facebook ads, and then you had a $1,000 expense for your laptop. So your total expenses was $1,250. So the net income for January on your profit and loss statement is going to show a net income or profit of $3,750, right? Easy math, okay? The revenue of $5,000 from your sales, we know, increases the business earnings, right? And we know that the expenses of $1,250 reduces the business earnings, right? Leaving us a final net income or profit of $3,750, right? But here's why it matters. Because this tells us how much money your business is really making, actually making, okay? Now, let's shift into our balance sheet, okay? So we're gonna record this stuff on the balance sheet. So remember, ABC Pest Control in January, okay? So the balance sheet, a little different. So the categories, right? Assets, what we own, okay? Which we know right now, we actually have $5,750 in the bank in the cash because of our transactions that we talked about, okay? Then we actually have office equipment, okay? We also own that, and that's $1,000, okay? So cash in the bank is $5,750. Plus you own a $1,000 laptop, okay? So your total assets, which you own, is $6,750, easy. Now, then on the balance sheet, the next thing is the liabilities, what we owe, okay? What do we owe? We didn't pay cash for the laptop, we put on credit. We owe $1,000 for the credit card. The liabilities is $1,000, okay? And you took $1,000 out for compensation. Your retained earnings from your P&L from the previous month, again, $3,750, okay? So your total equity is $4,750, okay? So you gotta remember, right? It's not complicated. It's the owner contribution, like not distribution what you took, but contribution what you put in. Okay, so you put in $1,000. Remember, you start with $1,000. Your retained earnings from your business, which is after your revenue minus your expenses, with $3,750. So your total equity is what you put in, $1,000 plus the profit from January. So now you're at $4,750. Okay, and don't forget, your cash actually increased to $5,750 from the owner's investment and revenue sales. Okay, so the laptop is an asset, but it's also a liability because it was purchased on credit, okay? If you paid it with cash, it wouldn't be a liability, but you paid it on credit, so it's a liability, okay? All right, so profit, $3,750 from the P&L. Okay, remember, that gets put on the balance sheet as retained earnings, okay? In the equity section, right? Now let's shift into, right? So we have an idea. So this helps you guys understand why this is important, but shifting into why it's important for you, okay? Because remember, the balance sheet helps you see the full picture, okay? Of what you own, of what you owe, and what's left over. That's your equity, okay? Now, let's discuss real quick the differences between sole proprietor versus S corporation, okay? And really how it affects our financials, because it does a little bit here. Okay, so when we talked about this, the business types, you got a sole proprietor, and then you have an S corp, okay? And then you've got and each of them based off of how we do our chart of accounts and how we categorize everything. We've got like an equity section, and then we have like the equity section, and then the owner withdrawals. Okay, so as a sole proprietor, we're looking at the equity of the names of the equity, right? Which is the owner contribution and then owner draws, okay? But specifically, it's the money withdrawn by the owner that's recorded as the owner draw, okay? So it's that money. Then we move into the S Corp, okay? So your S Corps, what that equity section looks like on the balance sheet is going to be capital stock or shareholder distribution, okay? That specifically is the money taken out by the owner, recorded owner, but they're more shareholders, as shareholder distribution, okay? Remember the sole proprietorship, that's owner draws. Owners that pull money from a S corporation is shareholder distribution. So one of them you're an owner and the other one you're a shareholder, okay? And again, why is it important to you as a business owner? Because by golly, it helps you make sure that you're actually in the right structure for your business type. Because this is how, all of this affects how you report your income, how you pay your taxes, okay? And how you take money out of your business, right? We gotta make sure, here's a couple of the important things we need to make sure of, okay? And why it matters to you. It helps you, again, maintain accurate financial records, which is gonna help you ensure IRS compliance and avoid IRS issues. And trust me, talking from experience, it's not fun, okay? It helps us understand our financial statements, which again, leads us to the third thing, which is help us make smart financial decisions about our business, okay? So going to the most common mistakes that our entrepreneurs make is they only look at the bank balance instead of checking their profits, their liabilities, and their equities on their financial statements, okay? If you run your business by your bank account, I'm telling you right now, you're a business owner that is every day in a state of panic on how they're supposed to pay all their bills. Every day, you're in a state of panic because of that, okay? So some easy takeaways for us business owners. Remember, we're gonna kiss it. We're gonna keep it smart and simple, okay? So every transaction affects your profit and loss statement and balance sheet. Every transaction, okay? Your profit and loss statement tracks your income and expenses over time. Remember, it's the movie, okay? It shows you your profit over time. The balance sheet shows you your assets, your liabilities, okay? And your equity on a specific date. That's the photograph, that's the snapshot, okay? And again, understanding all of this helps you mind your own business, right? Okay, now we're gonna move into our next section, which is, I think, section 13, and this is gonna be our year-end adjustments that we have to make into our financials, okay? And this is how we have to make sure we go into the end of the year tying a bow on this, going into January to make sure that we're clean. And again, remember in January, the P&L starts over at zero, okay? So for you as an owner, this is why it's so important, because you have to understand how these financial statements reset at the end of every year, and you have to understand why it's so important and crucial for tax planning, financial reporting, and also long-term business growth. Like, these are just huge things, okay? So like every December 31st, you gotta understand, your profit and loss statement resets to zero. Okay, now remember, your balance sheet carries all the figures and everything, but the P&L resets, okay? And so let's break down this process and exactly what happens, okay? So if we're looking at the financial statements, okay, at the end of the year, your financial statements go through that resetting process. Sometimes something resets to zero, but it's a resetting, okay? And again, we've already said it. Your profit and loss statement resets to zero, okay? Your revenue and expenses for the year literally disappear off this thing. So that way you can track next year's income separately. You get that, right? You reset it every year so you can track each year's progress, okay? Your balance sheet, that retains the key balances, okay? Assets, liabilities, and your equity. What you own, what you owe, and what's left over, okay? That stays on the books rolling over to the next year, right? Then we move into our net income. That moves to the retained earnings. Remember, at the bottom of the P&L, what do we have there? It moves to retained earnings on the balance sheet, okay? That's the profit from the previous year moves into the retained earnings on the balance sheet, okay? Again, we're tracking everything, but I gotta reset this P&L. That's why I got to do it. And remember, here's why it's important to you. That P&L has to start fresh every year, okay? So you got to make sure you document the previous year's profit because the P&L resets, right? So remember, the balance sheet, though, its job is to keep track of all those numbers, okay? So like, this would be like a year-end adjustment example for you, okay? And let's use ABC Pest Control as our example, okay? So we're looking at our balance sheet. Remember, the categories are different for the balance sheet than they are the profit and loss statement, of course. But let's think about this. So your profit and loss statement showed the category would be like revenue for the source, which would be $5,000. Your expenses was what? $1,250, right? It was $1,000 laptop and then $250 for advertising. Net income was $3,750. What happens next? We take that. The P&L resets to zero on January 1st, and that $3,750 income, right, moves into retained earnings on the balance sheet, okay? This is what ABC Pest Control's balance sheet looks like after the end of the year, meaning January 1st, okay? The categories are different. Assets, okay? Cash, which remember, $5,750, okay? Moving over for paramedic, back over, okay? Then don't forget we have our liabilities, right? So liabilities we owe because we didn't buy the laptop on cash. We actually put on a credit card. So we owe $1,000 to the credit card, okay? So it's a liability for us. And then don't forget the equity. What's the equity? What's left over, okay? And that is comprised of a couple things. What you contributed in the business as owner contribution and the previous year's profit, which is captured where? Retained earnings, $3,750, right? So $1,000 plus $3,750, right? That's our earnings. It shows your equity, what's left over, $4,750, right? So I think we have an idea and understanding. Your assets, your liabilities, and your equity remain unchanged after the end of the year, okay? But the P&L has to reset, okay? Because the business has to carry forward so that we can track everything during each calendar year, okay? But this is why it matters to you, because your financial records don't erase any of your business history. They're not supposed to, okay? Their only job really is to organize your previous or past profits and losses, right? You know, like our job in accounting at our core, the most simplistic way to describe what we do at our core, we're just financial historians. Our job technically is to document what you did yesterday and then make sure that we appropriate properly in the chart of accounts where it needs to go, and then make sure that you're by the book for your local, city, state, and federal revenue collecting agencies. See what I'm saying? That's like literally what we do. But remember, the sole proprietor versus your S Corp are handled a little differently when we close out the end of the year, okay? They're similar, but there are a few small differences in how the equity and the retained earnings is categorized, okay? So if we're looking at the sole proprietor, under the equity section, okay, on your balance sheet, it's gonna be owner contribution and owner draw, okay? And your year-to-end profit, okay, moves to retained earnings. So no matter what, that moves to retained earnings, okay? But on your S Corp, under the equity section, it's different, okay? That shows, for equity, for the S Corp, that's gonna show capital stock and shareholder distribution. Because if you technically don't own an S Corp, you're a shareholder of the corporation, or as a sole proprietor, you actually own the business personally, but it still, as an S Corp, year-end profits always moves to retained earnings. Year-end profit always goes to retained earnings for the sole prop and S Corp, but the equity section names change based off of that, okay? So just keep that in the back of your mind. I think we have a clear kind of understanding of how that works, but it's important for you to know as the business owner, because the business structure determines how the money is categorized and taxed, okay? Which is the most important thing for tax planning. Duh, right? Okay. So let's shift over into kind of year-end adjustments, why they matter to you. Again, it's essential for tax planning. Again, it helps you track your long-term growth. And again, it helps you make smart financial decisions, okay? Now, here's a common mistake that entrepreneurs make, okay? A lot of times they assume that once the P&L resets, their previous year or previous year's income disappears. It don't. That money moves to the retained earnings on the balance sheet. Nope, cleared it all out last year. Oh no, we still tracking that, playa. We still tracking that, okay? Our takeaways, easy. Your profit and loss statement resets every new year, but the balance sheet keeps track of the long-term numbers, okay? Your net income from the profit and loss statement moves into where on the balance sheet? Comments, please. Retain earnings, thank you. Okay. And accurate financial recording helps you with your tax planning, right? Banks that want to give you loans, you want to grow, these numbers have to be dialed in, man. You understanding how your year-end financial adjustments, how they work, is going to be monumental into helping you plan every year your financials, okay? Let's move into the section 14, which is our final takeaways, next steps. I want to pull everything together for you guys. I want to congratulate the fact that you guys made it this far into 301, and this is basically section 3 of 301. I want to give you guys major kudos, okay? You guys understand, we're covering deep accounting principles, okay? And as a small business owner without a degree in accounting, a lot of this stuff is overwhelming. But I created this as a resource for you to go back to and listen over and over and over again, okay? Because it's so important that you got to understand, you have to understand how these numbers work. Remember the 7 plates of business, right? Plate 1 is the trade, plate 2 is the accounting plate. If you don't know how to spin this plate, you out of business, playa. You ain't gonna make it, okay? You gotta know how your financial statements work. You gotta know how your transactions affect your books, okay? You gotta know the differences between the business structures, which makes the most sense for me. You gotta understand this stuff, right? So I'll recap a bunch of stuff, and I think I can tie all this together for you guys, okay? Like if we're talking like the most important takeaways from the sections, knowing the differences. So your profit and loss statement, your balance sheet, your P&L tracks your income and expenses over a period of time. Your balance sheet provides a snapshot of what the business owns, what the business owes, and what's left over for a specific time. It's the photograph, okay? Your liabilities, right? So your net income from your P&L, remember, that moves to retained earnings on the balance sheet at the end of every year, okay? So the business structure, talking about your sole prop versus your S Corp, why it matters, okay? Your S Corp tracks, your sole proprietor is gonna track your owner contributions and owner draws. Owner contribution, owner draw, owner. Remember, a sole proprietor is a business you own. An S corporation, you're an owner of shares of the business, but you don't actually technically own the business yourself. You own the shares of the business, and the shareholders own the business, okay? So the S Corp, we track capital stock and shareholder distribution, okay? Not owner contribution or owner draws. Why it matters? Are you crazy? How your business is structured is going to affect your taxes. It reports your equity, specifically your equity reporting, okay? And it also helps us figure out how to withdraw the profits from the business. And we know the sole proprietor is just a W-2 employee of your own business, okay? Now, we talk about the accounting formula, right? The master equation. It's the foundation of every transaction that we have, okay? Remember, AS equals L plus E, right? So assets equals liabilities plus equity. You got to understand, every transaction in your business impacts at least 2 of your accounts, and that's what keeps it balanced, right? So if we take, we got to give. If we give, we got to take, okay? You got to understand that. Double entry accounting, make sure that each transaction has a positive and a negative, and that's how we get to 0, okay? Your chart of accounts, right? How we organize all this stuff, right? Chart of accounts, right? Your COAs categorizes your transactions into assets. It's the big 5, okay? Your chart of accounts categorizes your transactions into the big 5, okay? And when I say big 5, I'm talking about your assets, your liabilities, your equity, your revenue, and don't forget, your expenses, okay? So, I think you guys understand, having a well-structured chart of accounts makes your bookkeeping a billion times easier. Your accountant is going to love you. It's going to save you money because the accountant's not spending hours and hours fixing it, okay? And it's going to help with your financial reporting, which again helps you make smart financial decisions. Hello! All right, let's talk about journal entries and our T accounts, okay? And how we record these transactions and make sure we do it properly. You guys remember, every business transaction must be recorded with a journal entry. The same way the old school 1980s checkbooks, every financial transaction was an entry into the checkbook. Every business transaction is an entry, but it's a journal entry into the ledger, okay? Don't forget, it has to have the left and the right, because the T, okay? The debit on the left and the credit on the right, okay? Remember, your T accounts help you visualize this, okay? How the transactions impact the different accounts, okay? And you can see it visually. That's what makes it so cool, okay? And then don't forget, you got to make sure your journal entries are accurate, because if they're not, your financials are not accurate. And guess what? They will never be accurate. Did you hear what I said? They will never be accurate if there's a mistake, okay? Now, let's talk about what to do next, okay? So you guys have a clear understanding, right? Go back and watch these sections. It's going to help you guys plan this, have a clear understanding of what we need to do here, and focus really on how these journal entries are going to really impact your finances. And be honest with you, make it simple, like stupid simple, okay? Everything that I do has to be engineered where I can get to it within a couple clicks, because if it's beyond that, my brain it's Mount Everest and it won't do it, okay? So everything I have to do has to be, again, keep it smart and simple, all right? And so I want to make sure that you do the same thing as an owner. Remember, we as the mom and pop Venti shop have to spin all 7 plates of business. So we don't have the time to do anything that's complicated, okay? So we want to make sure that we apply all these lessons, right? So we got to start reviewing your financials weekly, monthly, with your business partner, with your spouse, with your accountant, or with somebody that can hold you accountable, okay? Let's make sure that you follow these smart financial principles, okay? Use the accounting equation, but do the expanded one, because that really helps you see how the money moves through your business, really in and out of your business, okay? Practice documenting those transactions, okay? You've got to practice recording them, okay? And again, in the beginning of your business, spreadsheet this stuff, man. It's easy, okay? But I'm talking the basic stuff, the date of the transaction, the account name, what was the expense, and give me a description. Like that right there is insano simple, okay? Now, we got to shift into preparing for your tax season, okay? and growing your business. And that's why you have to understand your profit and loss statements and your balance sheets and how they work together, and how their job is to make your job easier and your accountant's job easier, okay? Now, you understand, to do that though, you've got to keep clean financials. This stuff's got to be, when I say clean, accurate, okay? So use a spreadsheet, use your tools, use software, don't care, okay? Honestly, again, most business owners prefer QuickBooks only because Intuit has spent a gazillion dollars marketing to them that it's the only option. And trust me, it's not. There's lots of better options that are a lot cheaper, okay? But I always put that disclaimer out there because everybody wants QuickBooks because Intuit markets directly to business owners, right? But if I can finish by encouraging you, okay? The first time you do anything is the worst time you do anything, okay? So the first time you do anything, it is going to be foreign, like really foreign to you, okay? But typically by the third time you've done it, you've got like 70, 80% of the way down. You're like, okay, it's cool, right? Just remember, understanding your business finances equals business success. Understanding your business finances equals business success, okay? That's why under the 7 plates of business, it's plate number 2. Plate number 1 is the most important. If you do not know how to spin the trade, which is what the public knows you by, okay, you're definitely out of business. But if you do not understand the accounting plate, playa. The reason why it's plate number 2, because you ain't in business, okay? So understand, right? Your business finances equals business success, okay? And again, it's going to be complicated and seem overwhelming at first, but I promise you, with a few times of application, muscle memory starts kicking in, and it becomes more and more familiar. And then before you know it, you got this thing dialed in, okay? So talking about getting lost on this hiking trail that you're on, okay? If you're like overwhelmed, oh my gosh, it's too complicated, I don't know what I'm doing, go back to the beginning and back to the basics, okay? Track your income, track your expenses, okay? And ensure your balances are accurate. That's it. Track your income, track your expenses, okay? Expenses, keep it to the 4 things. The date of the transaction, right? The account name, the amount, brief description, okay? So again, in the beginning of doing your business, it does not need to be complicated. Do not overcomplicate this, man. One of the worst things I see business owners do is they will literally build a submarine to cross a pond. I'm like, what in the rizzle is wrong with you? You have a canoe right there. Open up a freaking spreadsheet or a Google Doc right there. Do not build the submarine. Do not build it. You're gonna be tempted to build it. Do not build it, okay? But your next steps are simple. You now have a clear understanding of the fundamentals of finances, okay? So your next steps are learning things like budgeting, how we forecast, tax savings. And by the way, we can help you with that all day long. I spend half my week building custom cash flow plans and budgets for our business owners and our retirees, right? So I want you guys to get ready because we're gonna move into the next section, which for us is 401. And there is so much to cover in that section. But guys, you understand, we're at the very end of this marathon. We can see the finish line, okay? So just buckle in, we're almost there. You guys are doing great. And you know what time it is, guys. It's time to get to work.